Hey everyone, welcome back to Corporate Decoder. Today we're cracking open the Hartford Insurance Group's latest proxy statement, and let me tell you, it's more exciting than your average insurance policy. Okay, maybe not, but we find the interesting bits, I promise. It's like trying to find a hidden gem in your grandma's attic. Lots of dust, but occasionally you strike gold. This document is essentially a report card on how the company is doing and a chance for shareholders to vote on important decisions. Let's start with what this filing is all about. It's a Schedule 14A, which means it's a proxy statement filed by the company itself, not an outside party. It's letting shareholders know about the upcoming annual meeting where they'll get to vote on things like electing directors and approving executive pay. Think of it as the company's way of saying, here's what we've been up to, now tell us what you think. Mark your calendars, the annual meeting is scheduled for May 21st, 2025. Shareholders get to weigh in on electing the board, ratifying the accounting firm, executive compensation, and even a shareholder proposal. This year they get to vote on the board's 2025 long-term incentive stock plan and special meeting rights for shareholders. It is very important for a company to maintain a good image in the eyes of the shareholder. The letter from the chairman and lead director paints a rosy picture. They highlight strong financial performance, innovation, and talent management, net income ROE of 19.9%, and a core earnings ROE of 16.7%. Those are serious return numbers. This is them showing how their leadership is effective and creates money for the shareholders. They claim that the directors consistently operate at an exceptional level. This is something that shareholders will determine. First up, we have the election of directors. Basically, shareholders are voting to decide who gets a seat at the table and help steer the company. The board is recommending you vote for each nominee. It's like choosing your favorite characters in a TV show, except these characters manage billions of dollars. Now, let's look at the board nominees. We see names like Larry DeShon, Carlos Dominguez, Trevor Fetter, and others. Notice that almost all of them are marked as independent. That means they don't have any direct ties to the company other than being on the board. This is a good thing because it ensures they're acting in the best interests of the shareholders, not just management. The board is mostly independent other than the CEO. It is standard in companies to have the vast majority of the board be independent, other than the CEO. It is standard in companies to have the vast majority of the board be independent. The company emphasizes its robust evaluation process for the board. They conduct annual self-assessments and even bring in third parties every 3 years to provide an objective perspective. This is like the board giving itself a checkup to make sure it's functioning properly. It is said that as part of the process, the lead director led the board evaluation session in May 2024. There was consensus that the board is effectively overseeing the company's strategy and risk management. Next up, the audit committee. This committee oversees the company's financial reporting and internal controls. Donna James chairs the audit committee, and the committee's responsibilities include ensuring the company's cybersecurity is in check. The company needs to invest heavily into this area to ensure the protection of the data of millions of people. It is important that they remain focused. Time to talk about the accountants. The board wants shareholders to ratify the appointment of Deloitte & Toussel as the independent accounting firm for 2025. It's a formality, but an important one to make sure the books are being checked by someone objective. The board recommends voting for this item. They are the police when it comes to checking the company financials. Here's a quick look at the fees paid to Deloitte. In 2024, they got paid almost 11 million for audit fees, 1.5 million for audit-related fees, and 60,000 for tax fees. So a decent bag of cash for keeping an eye on things. It does not appear outrageous compared to a company of this size. Now for the good stuff, executive compensation. The board is asking shareholders to give an advisory vote approving the compensation of the named executive officers. It's a say-on-pay vote. The executives are getting paid quite a bit. It's important that they are performing in line with shareholders' interest. The board recommends voting for this item. Let's get into performance and pay. The company had a strong year. Full-year net income available to common stockholders and core earnings were $3.1 billion each. I am not a fan of this. It seems like these numbers should be further apart, and it seems like the company is underreporting. Net income and core earnings return on equity were 19.9% and 16.7% respectively. That is amazing performance and a very high RO. These would lead to good bonuses for management. Check out how the CEO's pay is structured. Only 7% is base salary, while a whopping 73% is long-term incentive. This means his pay is heavily tied to the company's long-term success and stock price performance. In the company Proxy, they show that the compensation committee updated the award mix for 2024 long-term incentive awards. This goes in line with tying pay with performance. Here's a snapshot of the base salary, potential bonus, and long-term incentive compensation, known as LTI, for each of the top executives. We see that Christopher Swift, the CEO, made about 1.2 million in base salary, almost 5 million in the annual incentive plan, and 12 million in long-term incentive. Now, his total compensation is 17.9 million. These guys are making serious bank. The company president, Mo Tucker, made considerably less. It is a good thing that there are a lot of what we do than what we don't do. It is worth noting that senior executives generally receive the same benefits as other full-time employees. Double trigger requirement for cash severance and equity vesting upon a change of control, which protects the company's money. Stock ownership guidelines for directors and requirements for senior executives ensures that they care about the company. There are also many points in the what we don't do section, which is great to see. The company is asking for approval of a 2025 long-term incentive stock plan. The plan authorizes the issuance of up to 8.5 million shares, which includes the remaining shares under the previous plan. On the recommendation of the Compensation and Management Development Committee, the board approved the plan and recommends approval by stockholders. A lot of what this is about is what we spoke about earlier, making sure that management is incentivized to perform. Here's a shareholder proposal asking the company to allow shareholders owning just 10% of the stock to call a special meeting. The board is against this, saying that the current threshold is better for protecting the company and prevents a small group of shareholders from hijacking the agenda. They say the current threshold is 25%. I'm on the board side for this one. How much skin do the directors and executive officers actually have in the game? This section shows how many shares they own. Christopher Swift, the CEO, has a lot more stock. It is great to see them tied to the success of the company. This section highlights the big players. The Vanguard Group, BlackRock, and State Street Corporation are the major holders, each owning a significant chunk of the company. These are the big boys you need to listen to. It's like having the popular kids at school supporting you. Okay, time for some accounting magic. This section reconciles the company's reported numbers with some non-GAAP measures. These are alternative ways of looking at the financials that the company thinks are more useful. The Hartford explains its use of core earnings, which excludes certain things like realized gains and losses. They believe core earnings provides a clearer picture of their operating performance. Now let's put this all together. The Hartford had a strong year financially. The company continues to be profitable and grow its shareholder base. It is a little concerning that the numbers reported by GAAP and what the company uses to measure compensation are so close. This could potentially lead to management doing actions that benefit this metric instead of growing other aspects of the company. The management does a good job in providing good optics. It is nice to see that they stress their culture of ethics. The stock has some potential upside if it can maintain this trajectory. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more deep dives into the world of corporate finance. What company should we decode next? Let me know in the comments below.